Good evening. Thanks for joining us. We're just 61 days away from the 2020 general election, and early voting starts on Tuesday, October 6th, just about 4 weeks from now. We've received a lot of questions about the markets, economy, and especially the coming election, and we'll address all of these tonight. As always, reach out to us individually if we can answer any questions or otherwise be of service. We're here for you. We've done election updates since 1990, and we're privileged to have one of the most connected folks in Washington updating us this evening. Jeff Bush from the Washington Update will speak in just a few minutes. He'll discuss the pandemic response, the national election, and 2020 considerations. We continue to hear that with regard to the pandemic, the election, and the markets, that this time it's different. And in some respects it is, but in many it really isn't. We view this as not a new normal, but a normal normal. Change and uncertainty have always happened. Do you remember when people put on dress clothes to travel and then smoked on airplanes? Perhaps you remember when seatbelts started being required in cars, or when email was created, or eBay or Amazon became household names. Perhaps when you got your first cell phone or even your first smartphone. Can you imagine not having a cell phone today? In 1968, wearing a seatbelt in a vehicle became a legal requirement in the United States. Many people complained, and some people even cut them out of their cars. Not so much today. It wasn't until 2000 that the United States banned smoking on all flights to or from the United States and within the country. Change can be difficult, and the pace of change continues to accelerate as technology leads to more technology being developed. As we hear more about how the pandemic is going to change our lives with more digital interaction, face coverings, and other requirements, we don't consider this a new normal, but rather a normal normal. Now, I've been in the financial services industry for more than 32 years. Corrections, uncertainty, and even pandemics are not new, nor is the reaction of the markets. Focusing on market swings and news stories can distract us from our overall plan. It's kind of like watching a guy walking up a hill with a yo-yo. If you watch the yo-yo going up and down, you kind of miss the progress up the hill. So what is different now? Well, one of the things is the speed at which things are changing and the overwhelmingly negative 24/7 media attention. Any pretense of objectivity is gone from many news channels, which now provide commentary rather than reporting the news. We believe there are three new factors that are exacerbating the volatility that we're experiencing and making people more anxious. First of all, the prevalence of social media and stories that are often completely false or only partially true. That, combined with competition among the mainstream media, which creates more focus on the negative. It's ironic, it's illegal to scream fire in a crowded theater, and yet the media seems to do this every day. We have to keep in mind that the role of the media really isn't to inform, but to sell advertising. The other thing that's really increasing volatility is autonomous computer trading. In the 1980s, about 15% of all stock trades were done with computers. Now, on a typical trading day, autonomous trading accounts for 50 to 60% of the trades. On a day like today, which is very volatile, the computers can make up to 90% of the trades. Now, the pace of change on the positive side is happening as well. The speed of the government's monetary and fiscal response to the pandemic and the resulting economic shutdown has been unprecedented. One can certainly argue about the public health response. However, the monetary and fiscal policy was quick and decisive. What took more than 14 months in 2008 happened in a matter of weeks in 2020. Congress pumped more than $4 trillion into the economy. which you'll hear about in a few minutes. Moreover, the Federal Reserve essentially said they would keep rates low until and if there was a problem that couldn't be resolved. Now, as different as 2020 feels, we've been here before. A year with riots in 110 cities across the country. A pandemic that's killed more than 100,000 people in the United States and more than 2 million worldwide. And riots in Chicago preceding the election and concern about wars overseas. Now, what I've described is not 2020, but 52 years ago in 1968. Following the assassination of Martin Luther King on April 4th, 1968, there was a 4-day period of riots across the country, much like we've experienced post-death of George Floyd. In 1968, there was a pandemic that came from China, influenza A, that killed an estimated 1 to 4 million people worldwide and more than 100,000 people in the United States. The majority of the deaths were people over 65, similar to COVID. The Democratic Convention was held in 1968 in Chicago from April 26th to April 29th. And as delegates went in to the amphitheater to nominate a Democratic Party presidential candidate, tens of thousands of protesters swarmed the streets protesting against the Vietnam War and the political status quo. By the time Herbert Humphrey received the nomination, the streets of Chicago had seen riots and bloodshed following both protesters and the police. Now, in the coming months, we anticipate continued negative media regarding the coronavirus, the markets, politics, the election, the economy. We expect more volatility. But it's not bad news that necessarily creates anxiety, either personally or the markets. Rather, it's uncertainty. And that's why we have Jeff Bush here to shed some light on the election, where we've been this year, and perhaps where we're going. Our team at Carver Financial has more than 250 years of combined experience and has helped our clients weather many turbulent times. Our process is not based on forecasts or predictions, but on you. The fact is, we don't know what we don't know. And moreover, it's never the bus you see coming that hits you, it's the one you don't. And that's why experience and process are important. Our personal vision planning process is proactive and based on maintaining your lifestyle today and enhancing it in the future, not chasing a benchmark. Again, we don't want to focus on the yo-yo, making emotional decisions based on limited or biased information. We do believe that people face 3 major risks today, and the largest is not the markets or the economy. The first risk is simply doing something to hurt oneself, like panic selling. The second thing is not investing to keep up with inflation. Many of you may have paid more for the last car you bought than the first house. Keeping up with inflation is important. And the third one is an uninsured medical or long-term care expense, which can be helped with proper insurance. Now, a cornerstone of Carver Financial has always been the mindset of continuous improvement, both with our team's education and our technology. We continue to evaluate technology and processes that allow us to create a more personal experience and manage your portfolio more effectively to keep up with the pace of change. You may have heard Raj discuss some of the exciting developments during our town hall meeting in June with regard to technology we've developed, and/or you may have spoken to your financial advisor about this. The new technology doesn't change what we've done for the last 30 years. It simply updates how we do it. And we believe it can help you take advantage of volatile markets. Working with Raymond James, we've created a new portfolio monitoring and money management system, which we launched in July. This allows us to assign a custom allocation to your accounts, including cash you may need, and then monitor it utilizing a computer algorithm. This is not computer trading, and nothing happens without us reviewing it. Our investment philosophy, process, and the experience you have has not changed. It's important to note this doesn't guarantee you're never going to go up or down. It doesn't guarantee against volatility. What it does do, we believe, is help us maintain an allocation that makes sense for you. Now, separate from the new monitoring software is an update available called Discretion. Discretion will provide your advisor with greater flexibility to make adjustments to your portfolio in between regularly scheduled meetings, and also to take advantage of the new monitoring software. The recent volatility in March and April further confirmed the need to be able to make strategic adjustments in a very timely manner. No matter what happens, you always receive written confirmation from Raymond James on any adjustments. There's no cost to add Discretion or utilize the new software. Combining the software with the new discretionary management process allows your accounts to be rebalanced to your allocation that you agree with your advisor in real time. Your advisor can speak to you about your specific situation if you have questions on this. The thing we've had the most questions on recently is the election. And this evening, we have a very special guest, Jeff Bush. Jeff's a dynamic and insightful speaker and an author. I've known Jeff as a fellow pilot going on 10 years. Jeff is known for his unique ability to translate difficult and often confusing tax and fiscal information coming out of Washington, D.C. into strategies that investors can use and information that we can all understand. When Jeff left Wall Street, he was managing a $50+ billion sales organization. And this evening, we're privileged to have Jeff help us. So please join me in welcoming Jeff Bush.
Well, thank you, Randy. I appreciate that introduction. And it's great to be back with the Carver Financial Services. It's been a few years, but I really appreciate the opportunity and your clients taking the time to watch our presentation here this evening. And when I was thinking about this audience, I said, I really ought to come up with a metaphor, or picture, if you will, for how politics has felt over the last 9 months. And it wasn't until I came across this picture of this road sign that I thought, that's perfect. That's exactly how it's felt in Washington, D.C. We thought we knew where we were going in 2020. We got turned around, we got sideways, we got sideswiped by a few tweets every now and then. It's just been a crazy 9-month period. But it's that craziness that gives us a very robust opportunity to have a broad discussion today regarding not only the coronavirus pandemic legislative relief, we can talk about the national election, and I want to visit those 2020 considerations that I think you ought to consider given where we find ourselves in September of 2020. And we'll start with that pandemic response. Now, conventional wisdom is that nothing gets done in Washington during an election year. But who knew if you wanted to spend $2.8 trillion, guess what? You can get a lot of big things done. And it came in the form of various rounds of legislative relief, starting with round one, which was just that little down payment of $8 billion. Whoop, I somehow lost my clicker here. 1 second. I apologize. It started with that down payment of just $8 billion, and that was round one. But round two is when we got into the larger money. That's where we expanded Family Medical Leave Act, we included mandated sick leave, we received free coronavirus testing, and they moved the tax day to July 15th. But it was round three that we got into the real money. That was the CARES Act, and it was $2.2 trillion. That included the $1,200 checks that most Americans received earlier this year. It also waived our required minimum distributions for year 2020. It also included that $600 a week federal unemployment program that lays on top of the state unemployment programs, which is proving to be so problematic in the round four discussions. It also set up the Paycheck Protection Program, that PPP program that we've heard so much about. But we weren't done then. That Paycheck Protection Program ran out of money within 2.5 weeks. So Congress wanted to refund that. The Republicans in the Senate wanted to do that with $310 billion. And Democrats agreed it needed to be done, but they said, if you want our votes, we want something else in exchange. What they wanted was an allocation of that $310 billion to go to credit unions and community banks that tend to serve underserved communities. Beyond that, they also wanted money for testing and hospitals and the like. And that's what led us to this $2.8 trillion that we spent thus far. And even as financially savvy individuals, it's hard for us to get our head around just how big $2.8 trillion is. So I thought I'd give you a comparable. If you take into account every single revenue source of the federal government in fiscal year 2019, that was only $3.46 trillion. $3.46 trillion, and here we're spending $2.8 trillion, ostensibly over 8 to 10 to 12 weeks. So hopefully that gives you a perspective of just how big it is. But of course, you know, we're not done at $2.8 trillion. We're already talking about more. And while those negotiations have started and stopped, we do anticipate that together and that being those active negotiations kicking up next week. We'll see if it ends up stopping again, but at least they'll get started down that road. Now, even though we know there's no agreement, we do know what the debate playing field looks like. And it starts with aid to states and municipalities. We know states and municipalities have been especially hit hard during this pandemic because not only are their expenses higher, their revenues are down. Democrats wanted to give states $1 trillion. Republicans said, no way. We're not responsible for bailing out states that have mismanaged funds for years. We want to focus more on giving them flexibility with the $150 billion we've already given them and maybe add another $150 billion. Another issue that's come up more recently is school funding. Once we realized that this pandemic was not going to be done by the end of June or even July, we knew schools were going to have to open in some format, whether it's all virtual, all personal, or some type of hybrid. No matter how schools open up, it's going to be more expensive. What you may not know is that the federal government actually funds a minority, a relatively small minority, of public school funding. That all comes from the state. So the federal government, recognizing that need, recognizing that states didn't have that free capital, decided they need to pitch in. So school funding will likely be a part of round 4. Something that's happened more recently is funding the Postal Service. Democrats want to fund that somewhere around $25 billion to deal with this massive influx of mail-in balloting we anticipate for 2020, whereas Republicans are in the $10 to $12 billion range. Now, this other issue that's being debated is what about the Paycheck Protection Program? We know that ended back at the end of July, but we know there's still need, especially in the entertainment and restaurant industry. So I do anticipate additional funding into that Paycheck Protection Program, allowing these companies to come back for a second round should they need it. But understand that funding will be much more focused on smaller employers and have more controls associated with it. As you know, is a bit of a free-for-all in that round 1. Now, there is bipartisan support for expanding the employment tax credit. Right now, that tax credit is 50% of wages up to $45,000 a year. Some are talking about raising it as high as 80 or 90 or maybe even 100% of income, up to $90,000 in income per year. Now, why there's bipartisan support for that program is that this program is actually helping employers keep people on the payroll rather than lay them off, and they end up on the unemployment numbers. The employer liability as well as worker protections will be a big area of contention within this round 4 debate. Republicans see that unless employers have liability protection, they aren't going to feel comfortable bringing back employees. Now, keep in mind, this is a very broad definition of employer. It includes schools, churches, as well as traditional employers. But Democrats are much more focused on worker protections. But some combination of that is likely to end up in round 4. There is discussion about more payments to individuals as well. Remember those $1,200 paychecks or checks that came to most Americans? There is some discussion with the lapse of the unemployment program at the end of July, and clearly we haven't negotiated the next round of unemployment, that maybe American families need a little help to deal with that gap. But the real debate is going to be around what do we do with this unemployment program from the federal government. Democrats want to extend the $600 a week program until January 31st, 2021. Republicans want to turn it into more of a traditional unemployment program and pay a percentage of income. So if you made $1,000 before the pandemic, then you'd be eligible up to a total of $7,000 between state and federal in the federal unemployment program. Now, the challenge with that is the state computer systems aren't able to handle that coding right now. They would need a couple of months to get up to run and get ready for that. That's why the Republicans suggested that they pay a flat $200 a month until October 1 before the states could get those computer programs reprogrammed. One thing that has also come up in round 4 is the idea of infrastructure funding. Now, that's not going to go anywhere, primarily due to the fact that the Republicans' insistence on keeping the figure somewhere around $1 trillion. Well, if you want to do all these other programs, there isn't enough money to then fund infrastructure in any measurable way. Beyond that, we also know there are some tax changes being discussed. For example, perhaps lowering the corporate rate by half to 10.5% for corporations that repatriate jobs and revenue streams back to the United States. One thing we've realized through the pandemic is our country is way too dependent on specifically China for strategically important goods. Yes, things like masks and gowns and things like that, but more importantly, pharmaceuticals. If we can incent through the tax code to bring that production back here in the United States, obviously we'd be in a much better situation to throttle up or down that manufacturing based on whatever situation we're dealing with. At one point, there was some discussion about capital gains tax reduction. I don't think that will make it into round 4, primarily because you can't draw a straight line from reducing the capital gains rate to jobs or unemployment. So I tend to think that will not be in the round 4 package. One thing the Republicans are also focused on is expanding the ability of business owners to write off capital purchases in the year they make them. Under the Tax Cuts and Jobs Act, we have that opportunity until 2022. Republicans want to extend that. And the president's focused on giving businesses a 100% deduction for meals and entertainment. Under the Tax Cuts and Jobs Act, we can only deduct 50% of meals and 0% of entertainment. Well, we know the restaurants and entertainment venues have been especially hit hard during this pandemic. So can we, through the tax code, give corporations and businesses more confidence to go out and entertain clients once the economy starts getting back to normal? There's also a discussion about expanding the above-the-line charitable deduction that was created by the CARES Act from the current $300 a year to something around $4,000 for an individual or $8,000 for a joint filer. Now, if that above-the-line charitable deduction is expanded for non-tax itemizing individuals, that will be a great point to talk to your financial advisor about the desire to accelerate some of your 2021 charitable giving into tax year 2020 to take advantage of that opportunity. Now, some people were hoping we'd also get additional required minimum distribution relief for tax year 2021. I don't see that happening. And the reason why is the only reason we received RMD relief in 2020 is because our IRA valuations were based on 12/31/19 values, and they were quite high. But then the market really took a turn for the worse. So retirees were having to take out income out of a diminished account value based on that higher valuation. Well, that's a recipe for destabilizing someone's retirement savings. And of course, we don't want to do that. So we got the waiver for 2020. But because the markets have bounced back so nicely this year, I just think it's unlikely that that RMD gets extended into 2021. Now, we also know that, we also know the president took some action on his own. He expanded the unemployment insurance to the tune of $400 a week, with the states picking up $100 of the $400. Now, he's repurposing some money out of the Federal Disaster Relief Fund to make that happen, but understand that's not that big of a fund. It would only last about 5 weeks. And that's also especially challenging during an active hurricane season and all the California wildfires, because those disaster relief monies are meant to help support those relief efforts. He also talked about allowing employees now to defer their payroll taxes through the end of the year. That would effectively give a raise to every working American. But the key word there is defer, not waive. In other words, those taxes would become due, and they would come due in tax year 2021. A lot of employers are saying, well, Mr. President, I appreciate the fact that you're trying to give my employees an effective raise, but then I have to double dip them, effectively giving them an income decrease next year. I just don't think it's worth it. I think that's going to cause more headaches than it's worth. I'm just not going to participate. What President Trump did do on the college student loan front is he extended that deferral of principal and interest till the end of the year. He also announced the fact of an eviction ban. As you know, under the CARES Act, there was an eviction ban, but that expired. Well, they've now renewed that through the end of the year, giving families a little more confidence that they have housing during this time. And they did that through an emergency declaration through the CDC. In other words, saying it was a medical reason that we need to have this eviction ban. That's a little creative, but I don't think the Democrats are going to fight it. As a matter of fact, I don't think the Democrats are going to take the president to task on any of these things. I think it was a rather astute political move. He realized that he is pushing the legal boundaries of separations of power, but that would entail the Democrats taking him to court and saying, no, Mr. President, we want people evicted. We don't want people to have unemployment insurance. We want student loan holders to have to pay principal and interest. Obviously, they're not going to do that given the circumstances of where we are right now. So now that leads us into the election. Obviously, we're 60 days out now, and now is when the campaigning really begins, traditionally right after the Labor Day holiday. And so I thought it'd be important to kind of break the election down in a little more detail. Obviously, we know the two candidates at this point are Donald Trump and Joe Biden. And I think you would agree with me that Donald Trump is a polarizing figure. But you would also have to agree that Joe Biden's not really leading a Democratic movement. And I think that's what makes this race so exciting and so interesting to try to examine. But because we are down to the two primary candidates, it behooves us to spend some time on their platforms. After all, we haven't heard a lot about Joe Biden's platform since the debates earlier this year. Starting with Donald Trump, the Republicans' platform, it is important to note that they chose not to pass a platform during their convention last week, but it is clear what direction they want to go. They want to go more in the same direction, that whole America first, doubling down on that. But we know they also want to go forward on lowering taxes, making those temporary tax cuts of 2017, making those permanent. We also believe that Donald Trump, unencumbered by the risk of having to run for election again in 2024, will double down on leveraging the U.S. economy. You see, Donald Trump learned in his first term that not only could he leverage the U.S. economy via tariffs to get trade wins, but he also realized he could get foreign policy wins. And again, unencumbered without worrying about having to get reelected, I really believe he'll double down on that and be even more aggressive on the trade and foreign policy front. It's also anticipated that he'll continue these pro-business regulations that our businesses have enjoyed so much for the last 3 years. Now, moving on to Joe Biden, we know that Joe Biden did lay out a very extensive platform, and I'm going to run through it fairly quickly and kind of hit some of those high points. Starting with healthcare, after all, that is the number one issue for voters in 2020, he did give a nod to the progressive wing of the Democratic Party the day after Bernie Sanders dropped out of the race. He suggested that now he does support lowering the age of eligibility for Medicare to age 60. All it was the signal to the Biden supporters that, hey, Sanders supporters, come on over, support me, Joe Biden. I'm more progressive than you assume I am. But beyond that, he would also end surprise medical billing. Now, it should be no surprise that that's actually a bipartisan issue. Even Republicans want to get rid of it. It just needs to find the right legislative vehicle to get through the process. And we haven't found that quite yet. Well, we also know the more significant change that Joe Biden made on the healthcare front is he expanded a Medicare-like federal option within the Affordable Care Act exchanges. And that federal option within the Affordable Care Act exchanges would compete side by side with private insurance offerings. Now, it is a little bit unique because, of course, everyone would be eligible to participate in that program, but he would auto-enroll the 30 million uninsured Americans that we have in our country today. The value in doing that is overnight that program would be actuarially stable. Take yourself back to 2014 when the Affordable Care Act first started. You remember how the premiums were just extremely volatile? Well, they were volatile because there was the plans didn't have actuarial stability. In other words, they didn't have enough enrollees. Well, if you auto-enroll 31 million Americans, guess what? You're actuarially stable from day one. Now, we would also increase the premium subsidies within the Affordable Care Act dramatically in two ways. He would lower the percentage of monthly income that could be allocated towards health insurance premium from roughly 9.6% to 8.5%. But who would base those premium subsidies not on the silver plan, the way the Affordable Care Act's written today, he would base them on the gold plan. The combination of those two things would really increase the federal premium subsidies paid to those American families via the taxes that are collected on that 3.8% tax. On the pharmaceutical front, he would allow Medicare to negotiate for drug prices. And this is one of those ironies of U.S. politics. I think you would agree that Joe Biden takes a lot of credit, properly so, for helping pass the Affordable Care Act. But it's the Affordable Care Act itself that prohibits Medicare to negotiate for drug prices. So a little bit of a reversal there. He would accelerate generics into the system and come down on big pharma. What we also know is that Donald Trump also passed an executive order around pharmaceutical pricing back in July. What Donald Trump wants to do, is doing, is accelerating importation of certain drugs, and he wants to tie price increases to an international index pricing. We know the United States pays the highest for prescription drugs over any other developed country. He wants to tie it more to an international index, so we're paying the same as other developed countries. Joe Biden also put forward a $775 billion universal pre-care, child care, and elder care program because we know so many American families struggle with the cost of raising a family or maybe helping mom and dad out, or in that sandwich generation scenario, helping both the children and mom and dad out. So these programs would be there to help support those families with those challenges. On the Social Security front, he would end beans testing, although he didn't explain what he meant by that. The only thing I can think of is that he means ending that earned income offset. As you know, if you're on Social Security, but you're continuing to earn a W-2 wage, your Social Security payment is lower. So I think he's talking about getting rid of that, but again, it was a little unclear. He would give everyone a raise once they've been on Social Security for 20 years, and he would increase the minimum benefit to 125% of the federal poverty level. That percentage had slipped dramatically over the last several decades because the cost of living increases had been so small. On the retirement front, he had set up a federally sponsored 401k plan. Now, I want to be very clear. This is not the federal employee retirement plan. This is simply a 401k that the federal government is the plan sponsor. Believe it or not, in a normal economy, there are 41 million Americans that go to work every day, but they don't have access to a qualified plan like a 401k. So if they lack access to that qualified plan at work, they could just enroll in the federal program. He would also make some significant changes on the student funding front, as well as raise the minimum wage at the federal level. In an effort to make college more affordable, he'd make community college 2 years debt-free. He would make certain private colleges and state colleges tuition-free for any families earning less than $125,000 a year. But we know a lot of families already have student loans, and he has a forgiveness program for that as well. And it's based on income. If someone has student loans, but they only earn $25,000 or less, they owe nothing. If they own more than, or if they make more than $25,000 a year, they get paid no more than 5% of their monthly discretionary income towards student loan payments. Assuming they made those payments on time, at the end of 20 years, whatever balance is there, they would be forgiven. Probably the most dramatic change that he would make is he'd make student loans dischargeable in bankruptcy. You may not know this, but student loans are a very unique asset in the U.S. financial system. If someone has a student loan and they're forced to declare bankruptcy, that student loan goes right through the bankruptcy process, and on the other side, they still owe that money. Not under Joe Biden's plan, now they would be dischargeable through normal bankruptcy, just like a credit card balance. Now, this does create a moral hazard situation. I tend to think it sounds good, it sounds sexy, but I think once it meets the legislative challenge, it can be a little bit difficult to get that done. Moving on, we also know that Joe Biden is made a significant announcement around economic development. This plan would add $700 billion to our system by forcing the federal government to buy U.S. manufactured goods and make a $300 billion payment into research and development. Our country somewhat backed out of research and development over the last several decades with the waning of the Cold War. Well, this would be a big reinvestment in that. Hopefully to spur on manufacturing back here in the United States, just like it did in the 50s, 60s, and 70s, and so forth. He would reconfigure the supply chains to benefit the United States. And what that actually translates is it would mean moving away from China, especially on critical medical supplies. One thing he would also do is consider pulling out of the Phase 1 China trade deal. He would renegotiate our way back into the Trans-Pacific Partnership. He would increase steel and aluminum tariffs on metals coming into our country to make domestically produced steel and aluminum more competitive. Bottom line is, when you read that whole economic plan, you probably agree with me that it sounds pretty darn Trumpy. And that's exactly my point. On the economic development front, there's not really that much space between Joe Biden and Donald Trump. And that's kind of an important takeaway. But it is also important to realize, once you start playing around with these kind of issues from a federal government level, that you are welcoming foreign retaliation and probably higher U.S. consumer prices. But maybe after this pandemic, realizing the supply chain challenges we had coming out of China, maybe we're all willing to pay a little bit more so that we don't have to deal with that issue down the road. On the infrastructure front, Joe Biden would make a big down payment into infrastructure spending to the tune of $2 trillion a year, or $2 trillion over 10 years, pardon me. And that was a big increase from his original program, which is $1.3 billion. And that, again, was a nod to the progressive wing of the Democratic Party. You see, he wants to focus a big part of that $2 trillion on green and renewable energies, with the goal of making the United States zero carbon and 100% clean fuel by 2035. Now, if you've done any research into that, you know that's a huge goal and very ambitious. That means stepping away from fossil fuels in the next 15 years. So technologically, I'm not sure we'll be there. As a matter of fact, I don't see that happening, but it is an ambitious goal that satisfied a lot of people on the more progressive left. But one thing I do want to make very clear, Joe Biden has specifically said he is not signing on to the Green New Deal, but clearly there's a lot of Green New Deal in this infrastructure program. Now, to Joe Biden's credit, at least he put forward how he wants to pay for these programs, unlike most of the other Democratic candidates. He wants to institute a $4 trillion tax increase, which is roughly a 10% increase year to year. But he wants to focus that tax increase on the one percenters. Now, let's talk about exactly how that turns out into the actual tax code. On the individual tax front, he would eliminate the Tax Cuts and Jobs Act for the wealthy. Now, he doesn't define wealthy. In some cases, he's used $250,000 in family income, other times $400,000. So we're not sure exactly where that cutoff is, but clearly he wants to end the Tax Cuts and Jobs Act. He would increase the highest marginal rate to 39.6%, and for very high income earners, he wants to bring parity between marginal rates and capital gains rates. So no longer would those high income earners get a discounted capital gains rate. They would pay the same as if it was earned income. He would also cap the value at itemized deductions at 28%. So even though you may be paying 39.6% marginal rates, your tax deductions would only be worth 28%, effectively a significant tax increase. He would also reinstitute the payroll taxes on any income above $400,000 a year. And remember, that's a 12.4% tax, half paid by the employee, half paid by the employer. But nonetheless, a significant tax increase. I know a lot of wealthier Americans use real estate losses to offset earnings and gains in other asset classes. He would put limitations on the ability to use those real estate losses. On the estate tax front, he would lower the unified credit from the very generous $11.6 million we enjoy today down to $3.5 million, although he does not specify a tax rate. He has given indication he wants to take the estate tax code back to the way it was, so I'm assuming he's talking about 40 or 45%. But even more impactful is he wants to eliminate stepped-up basis at death. And pardon me, I'm probably preaching to the choir, but let me explain. If you buy a security at $10 and it grows to $100 and you pass away, your children don't pay capital gains on that $90 growth. They inherit a basis of $100 under the current law. Under Joe Biden's plan, no, the children would have to pay capital gains on that $90 growth. Now, they don't exactly spell out as to when those taxes would be paid. Would they be paid at your passing, or would they be paid when the children sell the asset? We just don't know. On the corporate tax front, he would increase the corporate rate from 21% to 28% and institute a minimum 15% book profit tax. Again, let me explain. You've probably heard about these big tech companies that pay no federal income taxes at all, but yet to the SEC, they're reporting they're making all this money. Well, all that profit they're reporting to the SEC is book profit. And Joe Biden would suggest that it needs to be taxed at a minimum 15%. No matter how you cut it, that would be a big change in business models for any corporations that take advantage of those tax strategies. Now, moving on from Joe Biden and Donald Trump, I do want to talk about the general election more generally. There are some important days to keep in mind. Obviously, Election Day is November 3rd. The Electoral College gets together on December 14th. Keep in mind it's January 6th, 3 days after the new Congress is installed, that Congress actually validates the vote. That could, in a kind of worst case scenario, be extremely important in this presidential election. Regardless, we're going to have Inauguration Day on January 20th of next year. Now, a lot of people have been concerned with the fact that the pandemic is really tamping down the ability of people to come to the polls and so forth. A lot of people are suggesting that mail-in balloting is the holy grail. Well, it is important to keep in mind that general election voters aren't nearly as savvy as primary voters. And in those states that we've seen a big uptick in mail-in balloting and they've had primaries, it's been a train wreck. Ballots haven't showed up, they've showed up late, they're invalidated because of signatures or whatever issues. It's just been a horrible, horrible mess. Now scale that up to 50 states and 7 territories, and you can imagine what we're setting ourselves up for November this year. The good news is the 17 most competitive states already had mail-in balloting in place, so nothing really needs to change. But participation is all over the place. The states I'm worried about are the states that traditionally had maybe 2 or 4% participation. What happens when that 2 or 4% grows to 40 or 50% of ballots coming in by mail? I'm here to tell you states are not prepared for that this year. So what we need to prepare ourselves for is that November of this year, it's going to be a lengthy process before we really know who is the president of the United States, perhaps even who the next Senate will be in majority. All these things just add confusion and concern around election legitimacy. And what really bothers me is that both candidates are actually stoking that reality. President's suggesting that he may or may not accept the election results if he loses because it'll be due to fraud. At the same time, Joe Biden is suggesting that Donald Trump is trying to steal the election. Now, all of those things mean that both candidates are laying the predicate, if you will, for legal action after the November date. I think that's inevitable. Quite honestly, we often have legal challenges after the election, but I think this could be of a year 2000 type of scale. And that means that either candidate would just need to invalidate just enough votes in maybe as few as one state, maybe even just 1 or 2 districts within that state. And that could very well swing this election. I do think it's very possible the Supreme Court could have the final say in this election, again, like the year 2000. The question is, will the candidates accept that? Now, I know polls have shown that Joe Biden is leading. He's led for a length of time, even though it's now narrowing. He's been leading for some time. But I want you to be very wary of national polls. Understand we don't elect the president via popular vote, so national polls are quite irrelevant from an actual empirical perspective. Now, what they are relevant for are 2 things. They help influence perception and perpetuate momentum. That's the only thing that these national polls do. So as long as you understand that's the only purpose of national polls, you'll have a lot less heartburn over the next 60 days. We elect a president via the Electoral College. That's the math we really want to understand. And you know, no matter how you cobble 270 electoral votes together, congratulations, you're the next president. But we know certain states are going to go Democrat, certain states are going to go Republican, and we can bifurcate them out quite easily. By our count, that gives Joe Biden a lead of 232 votes to Donald Trump's 204. And when you look at the toss-up states, there just aren't that many. It's Arizona, Florida, Michigan, North Carolina, Pennsylvania, Wisconsin. Some people are now including Georgia and Minnesota in there. I'm not really convinced yet, but certainly these 6 are in play. Now, here's why we think this is so important. If you understand the math of the Electoral College, you realize that Donald Trump realistically only has one path through the Electoral College, and that's winning Florida. If Donald Trump doesn't win Florida, he's got a real challenge. If Joe Biden wins Florida, he only has to win 1 more of the remaining 5, and he'll be the next president of the United States. So the real simple version of that is that Donald Trump has a very narrow path through the Electoral College, where Joe Biden has several paths. If he wins or doesn't win Florida, it's a dogfight for the remaining 5 states. Now, all of those things are very interesting and lead one to believe that Joe Biden has the edge this year, and I think he probably has it right now, but we're still a long ways from this election. I want to give you some reminders as to why you may not put Donald Trump out. First of all, those who voted in 2016 and say they are certain to vote in 2020, Joe Biden's lead is cut in half. If you go to those swing states that I mentioned earlier and you say, swing state voter, who do you think is the better candidate to lead us out of this pandemic and rebuild the economy? Donald Trump has a lead of anywhere from 3 to 10 points. In those swing states, Donald Trump has a 48% approval rating. Well, if you look back at history, 48% approval rating heading into the election of a first-term president, that's actually not that bad. We also know that who else led the polls? Well, Hillary Clinton led them all the way through election. John Kerry was in the lead. Michael Dukakis was in the lead. And we don't call any of them Mr. or Miss President. Beyond that, it's been 28 years since an incumbent president has lost their bid for re-election. And there's still that big Democratic crevasse within the party. That crevasse between the progressive wing and the more moderate wing of the Democratic Party is alive and well. If the Democrats start getting confident about winning in November, you're going to start hearing legislative proposals coming out of the progressive left that will literally scare the dickens out of the Republicans. And that obviously would be a big motivator for turnout in 2020 for the Republicans. We don't think that while Donald Trump is trying to paint Joe Biden as a socialist, I don't think he'll be really successful at that. But what he could be successful at painting Joe Biden as a puppet for the more progressive wing of the Democratic Party. There's some evidence of that in the sense he's acquiesced in some ways to the more progressive wing. When actually someone's the presumptive nominee, they tend to move towards the center. But Joe Biden didn't do that. He actually moved a little more to the progressive left. We know Joe Biden hasn't really been unscripted. Even the town halls and interviews he's had, they've been scripted, and he's had notes to follow from. He won't have those in the debate. So if he does have some of those Joe Biden moments that maybe calls into question whether his cognitive abilities have slipped a little bit, obviously that could be a big concern for the Democrats. Now, if that does take place, the Democrats will immediately look through Joe Biden to Kamala Harris. And while the Democrats are trying to sell Kamala Harris as a moderate Democrat, that doesn't really match her voting record. She was actually quite progressive in her Senate votes. And if you go back to the debate performances, the position she put forward during those Democratic debates was quite progressive. She talked about things like her healthcare plan covering undocumented workers, mandatory buyback on guns, and things like that, all of which are extremely motivating to the more right wing of the Republican Party. Now, beyond that, we also know there can be a positive surprise in the economy or with a vaccine or something like that. And all it really has to be is to give Americans the opportunity to see the light at the end of the tunnel. If they see the light at the end of this pandemic tunnel, they'll immediately just look for an economic candidate. They'll try to make this election based on who they think will build the economy back faster if they have that confidence. Hence, I think why Donald Trump is really trying to get that vaccine out by the beginning of November. Bottom line, at the presidential level, there are just way too many variables to make a call at this point. Now, I was with you in 2012, if I remember correctly, Randy, and I said back then, 14 months in advance, that Mitt Romney was not going to win. Barack Obama was always going to win re-election. We saw it clear as glass. We just don't have that same clarity in 2020, primarily due to the law of variables that we've discussed here today. But we do have clarity around the House of Representatives. Republicans would need to take back 19 seats in order to gain a majority, but there aren't that many competitive seats. Because of that political gerrymandering, there are only 2,235 seats that are actually considered competitive. Well, that means that the Democrats only have to win 4 and they keep majority. So it's a fairly easy call to say the Democrats are going to keep the House. The other House issue that I want to make you aware of are state elections. It's the governors and state legislatures that are sitting after the November election this year that will redraw those U.S. House district maps. They'll redraw them based on the 2020 census, and those maps go into play in 2022. And they last for 10 years. So these governors and these state legislatures will likely dictate the majority of the U.S. House of Representatives for the next decade in our country. Now, the Senate does get a little more interesting as far as the math. We know that Democrats need to take back 3 seats if they gain the White House and 4 if they don't. And there are only so many competitive states. Again, Arizona, Colorado, Maine, and North Carolina are in that toss-up column. Now, what you've probably noticed, if you've been paying attention, is there's almost perfect overlap between the Senate toss-up states and the presidential toss-up states. It's one of those once-in-a-blue moon things that happen, where the Senate toss-up and the presidential toss-up line up, and then we'll come back into our discussion here in a moment. We need to realize, Democrats need to realize that Alabama is likely to go back to Republicans. The only reason they won Alabama in the 2017 special election is because the Republicans ran a gentleman by the name of Judge Roy Moore. If you remember that name, you probably remember he is a bit of a flawed candidate. So I want to go back to our call on the Senate. Right now, we do believe if Donald Trump wins, the Republicans will keep the Senate. But because of that almost perfect overlap with the presidential toss-up states, if Joe Biden wins, it means the Democrats are likely to take back the Senate. Now, that's why a lot of investors are getting a little more anxious about the idea of a Democratic sweep, controlling the White House, the House of Representatives, and the Senate. What might that look like if that took place? Well, I guarantee you there'll be a negative market reaction because the market does not like single-party control. And that's true of either party. Now, what we also anticipate is that we'd have a new tax code as early as tax year 2021. That heavier tax year would come down on corporations and high net worth individuals, and that means that there's less money in the marketplace. So that's a little bit of a headwind on that market, on the market. We'd also have to anticipate that pro-business regulatory environment we've enjoyed from a corporate profit perspective over the last 3.5 years would likely be pulled back under Joe Biden. So if that's the case, we need to think about what are some of those considerations in 2020 that we should be thinking about. Well, I think, unfortunately, we do need to take the Supreme Court into consideration. We have 2 judges of more advanced age, and one of which has had some physical problems over the years. So it's likely the next president of the United States will be appointing 2 Supreme Court judges. We know the Fed has also expressed an interest in increasing the desire for inflation. They've now said that they're not going to tie themselves to that 2% inflation. And if a Democrat president, he may be a little more comfortable, or she may be a little more comfortable in letting that inflation run a little bit hotter in order to keep the economy moving for the average worker and so forth. I really encourage you to meet with your Carver Financial Services advisor right now and update your plans and make sure they're tight, because the market's not going to wait for the election this year. The market is a forward-looking instrument. It will pre-price what it thinks is going to happen in this election. I also can ask you to thoughtfully consider asset allocation. As Randy pointed out, those mix of stocks, bonds, and cash, and getting that correct. But getting the right asset allocation married to the right asset location. And asset location is about having tax diversification. And Randy talked about that guy doing a yo-yo going uphill. I'm here to tell you that's what the tax code is going to do for the next 10 years. We see very clearly that the next decade, the tax code, tax obligations are going to go up. And if the Democrats have their way, they'll go up more steeply. If there's one thing the Democrats agree on is they believe higher net worth, higher income individuals should shoulder a larger share of a larger tax burden. But I don't want to spoil the party. I believe even if Republicans are in charge, I think the longer term trend is higher taxation, primarily due to the debt we've added since 2008. So if that's the case, your portfolio has to be asset located properly. In other words, have tax diversification, just like you have asset diversification, so that you get to manipulate the tax code instead of the tax code manipulate you. Now, with that, I'm going to turn it back over to Randy, but we do have our social media here. My colleague Andy and I spend 4 to 5 hours a day reading and researching. We'll post 1, 2, or 3 articles a day that we think are uniquely interesting. There's no cost to it. It's just to say thank you to the Carver Financial Services for having me. We don't sell anything to you. We don't sell your information. It really is just to say thank you and to keep abreast of what we're reading coming out of the common press. So with that, Randy, I'll turn it back over to you.
Thanks, Jeff. And also thank you to Eaton Vance for helping make this possible. And thank you to all of you. You know, we understand your friends and family may have some questions or just want a second opinion on what they're doing. We're always happy to speak to them without cost or obligation, whether they're clients or not. And we can meet virtually with folks any place in the country or around the world. We will upload a recording of this event in the next week or so, and you can see it on YouTube or our website, and of course you're welcome to share it. Our next live stream event will be October 7th. I'm going to be interviewing Kevin O'Leary, aka Mr. Wonderful from Shark Tank. Our office is open. We're following all of the guidelines and recommendations laid forth from the CDC to protect our guests and our employees. The majority of our meetings are virtual, however we can meet personally if someone wishes to do so. You know, Carver Financial's been in business for 30 years, and I've done this for more than 34 years. We've weathered a lot of storms by keeping our focus on the well-being of our clients, our team, and our community. We believe the pace of change is going to continue to accelerate, and the amount of conflicting and incomplete news will continue to increase beyond this crazy election season. The updates so far with our website, monitoring algorithm, and other staff reflect our commitment to continuous improvement in the way we serve you and our mission for making lives better. There have always been reasons not to invest, and yet the need today is greater than ever as people live longer and they need money in their lives to maintain their lifestyles. We see a lot of opportunities for those that can look beyond the short term. No matter what transpires, we are for you and appreciate the chance to share your journey because your vision is our priority. We thank you for joining us and hope you have a very good evening.